What do you do when the market goes down, like it has a drawdown like we just experienced? And what do you do now? Okay, so couple different questions. A lot of people have been sitting on, been thinking about, been coming up here over the past month or two. Okay, so I've got a couple ideas for you, and I plan to do this and get this out while the market was down. However, I wasn't quick enough to do that. But just a couple of ideas, a couple of thoughts. Okay, just saw something this morning. They were talking about Jim Cramer calling for another Black Monday, April 3rd, maybe April something or other is when he called for that, and the market's up 16% from that date. So your C fund S&P 500, it sounds like, was down at least 16% at one time. When your TSP or your investments, your accounts are down like that, what do you do? Okay, what kind of actions can you take? And I've just got a couple of thoughts for you. One is, I'm going to say, invest cash or more. Okay, markets down like that, it's typically a good time to be buying, to be investing. So if you have any cash in your accounts, say you have a lot of money in the G fund, TSP, okay, maybe that's a time where you want to be taking some of that money and investing that in stocks. Okay, got to keep in mind your risk tolerance always. But you have cash in a savings account that's built up. Maybe you take some of that money and invest that into a brokerage account or a Roth IRA at that time. But that's one thought, one idea to do. Two, we can do some tax loss harvesting. Okay, so if you have a brokerage account, okay, so just a regular taxable account, and you have positions in that account, you can review that account, see if you have positions in there that are at a loss, and you can look at selling those positions to harvest that loss for tax purposes. Okay, and then invest it back in something similar. It can't be too similar to avoid the wash sale rule, but tax loss harvesting is something that's a good thing to do when the market's down. All right, now, third idea is Roth conversions. All right, so this is something I typically do with clients every year at the end of the year. But sometimes there may be a reason, maybe a good reason, to do conversions prior to the end of the year. Okay, what makes it good to do at the end of the year is because you have received most of your income for the year, so you know exactly what your tax situation is going to be that year. However, if you're retired, probably have a good idea of what that tax situation is going to be. Maybe not exactly, but a good idea of what it's going to be. So you could look at doing Roth conversions prior to the end of the year. You have a drawdown of 15%. Okay, your account value, your IRA, goes from here down to here. Why not do the conversion after it's decreased and gone down, move money into the Roth then? Now it has more potential for growth in the Roth. So Roth conversions, when the market's down, when we have market volatility, okay, you see drawdowns in the market, typically a good time to be looking at doing Roth conversions. Okay, so those are three things you can be doing when the market is down. Now, what should you be doing now, or what can you be doing now that the market has more or less recovered since the beginning of the year? So the market is flat right now compared to where it was to start the year. All right, so it's come back from that 16% drawdown, or whatever exactly the drawdown was. So what do you do now? Is there anything you should be doing now? Well, one thought that I have as far as what you should be doing now is reviewing your risk tolerance. Okay, how are the last 2 or 3 months for you? All right, were you able to sleep at night? Were you uneasy? Were you looking at your account daily? Were you complaining to colleagues, complaining to family members, complaining to your advisor, whoever it may be, that, hey, I'm losing money. Hey, I'm losing money. I need to do something. What are we going to do? I don't know that I can handle much more of this. And maybe that was you, maybe not. But now is the time to be looking at your allocation, okay, and seeing if you need to be making adjustments, okay? It's not the time to be doing it after you just lost 15 or 20%. All right. Now that your stocks have hopefully the portion of your portfolio that's in stocks, hopefully that's recovered. So now is the time to be looking, okay, is this something I can handle? Because really a 16% drawdown is not a big one, okay? 20% drawdowns are somewhat normal when you're investing in stocks, okay? And we didn't get to 20. So look at that now, all right? So next time we have a 20% drawdown, okay, are you going to be able to handle that? Or are you going to call it quits at that time and say, I can handle it, get me out. I want to move all my money to the G fund, want to move all my money to bonds, okay? And only you know how you've handled drawdowns in the past, okay? How you handled a 2020, how you handled 2008, how you just handled this one. And if you really struggled, maybe you do need to be more conservative, okay? Historically speaking, yes, stocks have provided the highest returns over long time periods, but that doesn't really you're not going to get those higher returns, okay, if you don't stay invested for the longer time periods, all right? If you're moving your money out when you get uneasy after market downturn, then, okay, you're not going to get those returns. Then you're just going to do damage to your portfolio and hurt your retirement income, okay? So now's the time to be looking at this stuff. Do you need to make adjustments? Do you need to be making changes? Do it now that the market's recovered, okay? Again, disclaimer, everybody's different, not specific financial advice, but something for you to consider, something for you to think about, okay? Thanks for watching. Please like, share, subscribe, share with a friend. Thanks, guys. Bye.